Good evening, everyone. This is Adil Rizvi, your friend, and I welcome you all to this live webinar for Tuesday, the 8th of October. Now, if you are watching this live, please let us know. Please put a hello, a wave, a comment, anything in the comment section because we are live currently on multiple social media platforms. So, wherever you're watching us, please leave us a high five or a comment, and if you're watching a recording, please let us know that you watched the recording. Hit the button recording, and we would know that you have watched us. If at any point you have any questions, whether you are live or whether you are watching a recording, please post that in the comments because that's what these sessions are for. And we will be answering your questions. If you post them live, then we will endeavor to answer them today. Otherwise, we will answer them later on next week if you post them under the recording section. So I would like to start today's webinar quickly. I know the topic for today is very, very interesting, how you can go about and find those high growth suburbs where potentially you can make 100 grand of wealth safely over the next 12 months. So that is what the topic for today is. I'm really excited to bring it to you, and I will share some very, very good key insights, the right methodology as to how we have been doing it. More than happy for you to use it for your own research as well. And towards the end, we will have the deal of the week. So we have introduced this deal thing right at the end of every week just to share as to where are we buying for our clients, what does it look like, what do the numbers look like, just to give you also some insights and some perspective about some of the deals we have been sourcing for our clients. So let's dive straight into it. First of all is the financial disclaimer. So the disclaimer goes that any information presented in today's webinar is purely generic in nature and does not take into account your specific and your personal situation. Let me quickly share my screen. So this is the title for today, but moving on. So whatever information we are providing today, it's not any kind of financial, legal, or tax advice. Please ensure that you seek your independent professional advice before deciding to act on any information presented or discussed today, because the information presented today may or may not be applicable to you because we are not aware of your personal circumstances. So this is a very, very clear disclaimer, guys. This information is very generic in nature and just to guide you along the right path, right? So before we delve into our topic, I wanted to share something very, very quickly about a news that came through a few days ago, and that was about one of the largest residential builders, Metricon. Yes, so Metricon is selling to this Japanese giant Sumitomo Forestry Group, which essentially means that more than 1 out of 10 houses in Australia will now be built by this Japanese company. And the deal is going to be cracked for around $115 million. For an average consumer, for an average home buyer in Australia, it does not make much of a difference because the house prices or the build prices, the cost to build a new house, are not expected to drop because of this thing. Uh, there's a bit of a good news because a lot of smaller builders have been going bust recently. About 3,000 of them went bust in the last financial year alone, as per Nine News. And the main reason of that is that the cost to build is just increasing too much. The end consumer cannot afford that anymore, and the builders have to pass it on to the end consumer. So builders are not make their ends meet as well. So the smaller companies, the smaller builders are going bankrupt, and potentially Sumitomo Forestry Group has deep pockets. So it's kind of a welcoming sign that people who want to build their own homes in Australia can actually have a bit of a sigh of relief because now a Japanese company will be doing a lot of builds, and they are financially potentially a bit more sound than what some of the local builders have been in Australia, especially the smaller builders. So that is where it is expected that this is a welcoming news. Another important thing is that once the interest rates start dropping, Tim Reardon, the president of HIA Group, mentioned this thing that once the interest rates start dropping, there is a likely spike that we may expect in the building activity. However, the building approvals have been dropping from the councils, so councils are not approving enough new houses. However, we need more housing, right? So the shortfall of lower supply and higher demand continues. So that misalignment is still there. So that is one news I wanted to share with you guys. And moving on to our topic for today. So we will be talking about. Please leave me your questions, whatever you are leaving here. And we have from one of the LinkedIn users. I can't see the name for some reason. Yes, availability of new homes will not really be impacted much. That's the question with this new Japanese acquisition, because it's more about how much can the if they can bring the prices down somehow to build new homes, then definitely it will help the consumers. But what will really dictate the building of new homes is, one thing is council approval. The council approval needs to go up as well, but also the affordability and the capacity of people to actually put money towards building new homes. And that has been stretched right now because of increased interest rates. So I think once the interest rates start moving in the downward direction at some point of time, not exactly sure when, but once that starts happening, I think more people will be able to afford more homes, to build new homes, and that is when we will see more activity. But one thing is good with the Japanese acquisition, that we will have some stability in terms of the builders who were going bust before. This is a good news for the local building industry, that a big overseas giant in the building industry is coming in and helping out the Aussies at this time. So that's a good news in that regard. So what we are going to do today, we are going to get into a lot of data and identify how these growth suburbs can be identified. Now, some very quick fact checks over here and some assumptions. There are more than 15,000 suburbs across Australia. Not all of those suburbs grow at the same value. I've been saying that over and over again. Not every suburb will increase at the same rate. There are so many different data patterns, so many different data indicators, which actually will decide which suburb moves first or which suburb will move faster as compared to the other. So what we are doing today is that we are trying to focus on suburbs which will give us more than the average growth, right? The average growth as per the last 35-40 year data is around 6.8%. So the property prices roughly increased by 6.8% nationally. But we are looking for suburbs which will give us 10 to even 15% growth over the next 12 months, so that we can beat that average 6-7% of growth and make that extra wealth, which will help us move ahead in that journey of property investing. Because we want to do it in a safe manner, we want to do it in a more predictable manner. So that is what our aim is for today. And also, one thing which we are really struggling, everyone is struggling, is the cash flow. So one big assumption for today is that we will not be looking at suburbs where the rental yields are very low. We will try to go into suburbs where the rental yields are a bit decent, which means 4.5% of rental yield or above. That is a key criteria, because we want the rental income to cover most of our mortgage repayment. What that essentially means is that 4.5% rental yield means it's about 520 weekly rent for a 600K property. So that's what 4.5% of rental yield actually means. So we are not too much negatively geared in that sense, right? And we can afford that next investment. Also, the next criteria is that we are looking for suburbs which have reliable data, which means which have done a lot of sales, which are not brand new. We are not looking at suburbs which have only sold 2 properties in the last 4 months kind of thing. So we are looking in well-established suburbs, and we are looking at suburbs which are well-connected as well. Then we are targeting houses for today's search, because the land is the thing, or land is the component that grows in value. We all know that, right? So we'll be focusing on houses, not units, and not townhouses for today's discussion. Units and townhouses also go through growth, but that typically is not the same when you compare it with the house growth, right? So houses is our primary focus for today. I'm not saying that units and townhouses do not grow at all. They do grow, but usually the growth is very, very slow for them as compared to the standalone houses. Also, for today's search, our budget is up to 900K. So we are only targeting houses in high growth suburbs where we have decent rental yields and the budget is less than 900K. So we are looking at suburbs where the budget is around 500, 600, 700K properties, 800K properties, so that they are more affordable, right? So this is our key criteria. And now we are about to dive into the search. And what essentially we are looking to do is price growth. I've shared this slide before as well with you. I just love this slide because it talks about the basic economic principle of supply and demand. This is where the supply and demand imbalance actually decides the price direction for any commodity, and real estate or property is not different from that. So what we are looking to do over here is, for the next 2, 3, 4, 5 years, we are trying to foresee what suburbs will be the ones where the future supply is likely to stay low and the future demand is likely to stay higher. And if if a particular suburb has had really good low supply before and high demand in the last 2, 3, 4, 5 years, it doesn't necessarily mean that the same pattern will continue for the next 5 years as well for that suburb. It may well change because it depends on a lot of variable factors, a lot of different data factors, which we will be going through today. So that's where we are focusing on. Yes, past performance is really important, but our goal is to identify areas where the future demand will keep rising, which will be based on population, incomes, a lot of other factors. And the future supply of properties remains low, so that there's more competition for the property that we want to buy. And more competition means more people want to rent it, more people want to buy it, which will keep increasing the price of that property and also the rental income for that property. So that's what our target is in very simple terms. Now let's delve further into it. So these are the now again, there are a lot of different data factors we can go through, at least 30 to 35, 40 different data factors, but I've picked up some of the key criteria which we use every day, and you can use them as well to actually find how to identify those growth areas. I'll go through them one by one, and I will also share the resources from where you can find that information, because that will start making more sense. One more thing I need to tell you is, not there is no suburb in Australia which will have all the data patterns working perfectly. So there is some kind of trade-off that we will have to make, and I will talk about it as we go along, right? So the first thing we are looking at the target suburb is renter proportion. What that means? Renter proportion means if there are, for example, 100 houses in a suburb, then at least 60 or more of those houses should be owner-occupier houses. At least 60 or more families should be living in their own houses if that suburb hypothetically has only got 100 houses, which means the other 40 houses or less than 40 houses are the ones which are tenanted or owned by landlords. Now, why do we want it? If we are looking to buy an investment, which we can buy anywhere across the country, doesn't really matter as long as it is in a high growth area. But why are we targeting these high owner occupied areas? There's a very simple reason to it. Let's say if you own your own home where you live and you own an investment property as well. You may be living in Sydney or Melbourne where your home is, and your investment property can be in some other state or some other suburb. If you lose your job for whatever reason, or if you have a financial crunch, and if you have to get rid of one of those properties, which one will you sell first? The quick answer is people will want to keep their roof on their heads right till the end, and they are more likely to sell their investment property first. So that is the key reason that we don't want to be in a high renter proportion area, because guess what? If 60 or 70 houses out of 100 are rented out and they're owned by landlords, guess what? If there's an economic situation, if there's a recession or something hits, those are the properties which will come to the market first. They will be selling first. And once they start selling first, suddenly the supply goes up. And that is where the demand is still the same. And that is where the price growth is affected. So keep that supply and demand seesaw in your mind that I just shared with you on the previous slide. This is the one. So we need to have the future supply low and future demand high. So that's why we are going in owner occupied areas, because that is where the owner occupiers are likely to hold on to their properties for longer, even when the economic situations are not good, right? So that is what the criteria is. Then we have vacancy rate. We are looking at vacancies of less than 1.5%. That's what we use for our clients. Again, the idea is we are identifying those suburbs where the vacancy is tight, less rental properties available, which means our property is likely to get more rental demand, and increasingly we can ask for more rental income, right? So vacancies rate has to be low, and it should be dropping. So if you look at the data, especially at DSR data, that's the source, the graph should be dropping. And if the graph is dropping and it still is less than 1.5%, that's a good area to be in. So I will definitely keep that suburb with me. The next is interest in the area. It's a very simple parameter which actually means how many people are actually searching for that suburb on google.com. So once they sit over there, if they search for Townsville, let's say in Queensland, or if they search for Butler in Perth, so how many times Butler is getting searched? So this is a parameter within DSR platform which should at least be more than 30, right? So if it's more than 30, it shows high demand. But again, we are not just looking at one data, we are making sure we have a low vacancy rate as well. We are also making sure that it is not highly inundated by the renters. It has low number of renters as well. So we are looking at all of these things together. Stock on market is an indicator of how many properties are available for sale at a given point of time. Again, that should be low, less than 2%. The reason is the same. We don't want to be in areas where there are huge new supply of coming. That's why we always stay away from suburbs where there are a lot of house and land packages, a lot of land which a developer can come and develop and suddenly start advertising for lots for sale or for house and land deals for sale or off the plan deals for sale. We just want to avoid those areas because these are the areas where the stock on market can suddenly go up. As soon as it goes up, again the supply increases, and because the buyers have more stock to choose from, they have more options. So if you buy in that particular suburb, suddenly your property is just one out of 100 other properties in that area, and which are on sale. So if you have to sell it in future, you will not get a good price growth. We are buying an investment with the perspective and with the mindset that after 10 years, 20 years, 30 years, we have to sell it at some point. That's why it's very important for us to look at that future data as to what the data is telling us. Guys, if you have joined us live, please keep putting your questions in. We will keep talking about some of these data parameters. We may go above the time frame today. We usually try to stick to within 30 minutes, including your questions, but we may go slightly above time frame because I have to cover a lot of information today. But please keep sending your questions. If you're thinking of anything, just type your question and share with us, and I'll try to answer them today itself, right? So another important criteria is we want to buy in areas where the growth in the last 3 years has not been like 50, 60%. And a lot of what's the reason for that? The key reason is if an area has enjoyed 40, 50, 60% growth, the likelihood for it increasing by another 50, 60% in the next 3 years statistically is minimal. Statistically, it just can't keep growing consistently because it's not sustainable, right? So we will look for areas which have only grown, let's say 20% in the last 3 years, only 30%, which is an indicator that they are at the bottom of the growth cycle. So the growth cycle which will happen for this area, remember every state has its own growth cycle, every suburb follows a certain growth cycle. So we have to target suburbs which are kind of at the bottom of the growth cycle. Because if we are able to pick those suburbs at the right time, in the next 3-4 years, we can have huge equity uplift and we can make that 100 grand, even 200 grand over the next 2-3 years, right? And that's what our target is. So that's where we are really strict on how much growth has happened in the last 3 years. Ideally, it should be around 30-40%, not more, right? Days on market, again, it's a simple indicator as to how much time it takes for a seller to actually get the buyer for their property. So if the day from which they advertise their property on real estate or domain.com, by the time they sign the contract. So that number should be less than 60. Ideally, it should be less than 50 because the market is really tight right now, but we have actually relaxed that criteria a little bit. Anything under less than 60 is a good indicator, is a healthy indicator, which means once the property hits the market, it gets sold quickly because the demand just absorbs it. Whatever supply is coming, the demand is absorbing it. If that days on market starts going above 60, above 70, I will stay away from those suburbs because that's where the demand does not seem to be enough. Properties are taking 2-3 months to sell, which essentially means that the price growth will be much, much slower over the next few years. Okay, now two important parameters we have over here, the population growth and the income growth. Now, we have to buy in areas where the population is increasing with time. And that information is available from ABS website, the Australian Bureau of Statistics, which is completely free. I will tell you the sources of all the information in the next slide for this data, but the ABS website is one thing which is free, right? So you can just jump onto it and find that information. Why do we want it? The reason we want our target suburb to be increasing in population is because with more population coming in, remember we tried to identify the suburb where the future supply is low, we will talk about it. And with the more population coming in, that population will need a place to live. So either they will buy a property or they will rent out a property. In either case, if our property is in that suburb where the population is going up, the chances for us demanding higher rents and the chances for us getting a better price if we have to sell it at any point are higher. So that's the reason that we always want to be in suburbs where the population is increasing with time. It should not be stagnant, and definitely it should not. Other thing is the income growth, which is very much related. The average income that people make in a suburb, that should also be increasing with time, because with more income simply means that people have more affordability. They have more to spend on rentals. They have more to spend on buying a house in that area, and the local population should be getting wealthier with time. So they should be making more income. They should be getting not richer with time, but they should be making more income. So that if they are not making more income, the problem is that the rents will not go up. It's not easy for the rents to go up because there's no one to actually willing to pay that rent. Yes, someone from other suburb can come and rent a property over there, but you have to rely on the local population for the demographics to work in your favor. So the local demographics for that suburb really dictate whether the prices go up for that area or the prices remain stagnant or even go backwards. So if the people make money, people income are going up, they are making more income, there are more people who want to live in that area. It's a simple indicator that this is a good area to buy in as of today, including all the above criteria which we already discussed, right? So we don't have to look at one or two criteria in isolation. You have to look at all of them together, right? Now, I will just full screen this over here just so that it's visible to you guys. Very important factor is that how close are we to employment hubs, and a lot of people confuse it with the CBDs. We don't have to be close to a CBD, but we have to be within 15-20 minute drive or 20-25 minute commute to a local employment hub where a lot of people are going for their jobs. Because suddenly your investment property is now more attractive to an IT guy who probably wants to do an IT job and wants to live close to his job, right? It's also attractive to healthcare worker who wants to travel to a local hospital which is maybe 10, 15, 20 minutes away. So suddenly your property is now more rentable. More people across different industries want to live in your property and rent your property as well. Now, future building approvals, I can't emphasize on this much, my friends. Future building approvals is a metric which is available on ABS, but it talks about how many approvals has council given for further development in that area, and that includes residential as well as commercial. So this future, let's say if a suburb has 5,000 dwellings, which means 5,000 houses plus units, everything combined, right? So the criteria that we have figured out after purchasing for a lot of our clients in the last 4 years is that criteria of new builds which have been approved in that suburb by the council should not be more than 9 or 10%. 9% is pretty much the criteria, 10% is the absolute max. What that means is if the suburb has already got 5,000 dwellings and the council has approved, let's say 600 new dwellings in the last 2 years, that is around 12%. So we will definitely ignore that suburb, because suddenly the future supply in the next 2-3 years, once all those dwellings are complete, once the builders complete those dwellings, they will hit the market in 2-3 years, they will be there for sale, and suddenly the future supply goes up, right? So going back to our criteria of the supply and demand seesaw, if the supply goes up, the demand is over here, suddenly your price growth stops. We need to be in areas where the future supply is going to stay low, right? So that is where this particular criteria of future building approvals is absolutely critical. I can't overemphasize on that. Please make sure that the future building approvals are really low, and ideally less than 9% of the total dwellings for that suburb. Social housing, another key criteria. Social housing relates to all those properties which are funded by the government, usually the state government or even federal government, where people who are on low wages or people who don't have any work, they are unemployed. So this is the housing for those people at cheaper rates, at cheaper rents. And a lot of times the problems that we have faced for this kind of housing is that people who don't make enough money or they are potentially not working at all, those are the people who are more prone to be potentially doing illicit stuff, like they may be in drugs in some cases, not all of them of course, but in some cases the likelihood of them being involved in drugs and other kind of activities which are not so very healthy from the societal perspective, they may be involved in those kind of things, which means you want to keep away from those houses, because someone who's not doing some good healthy activities, who are probably into drugs or something like that, they may have some road rage issues as well, and that street may not be a very quiet street. That is where you don't want to buy your investment property, because that is where you will struggle to rent that property out. So if you have probably just one house in a street of 50, which is for social housing, and some social housing are amazing, don't take me wrong on that. A lot of social housing have good families living in there, and you will not even realize that they're social housing if you drive past them. They are well maintained, the front yards are really nice and good, they are really good neighbors as well, but a lot of times it can be a problem as well. So the rule of thumb is stay away from social housing, and at least be stay 3-4 streets away from them, right? How do you figure out that out? I will let you know about this data sources shortly. But for social housing, you have to call the local property managers, you have to speak to them, you have to understand what kind of people are living there, whether there's any social housing in the particular street where you're looking to buy. And if they say that yes, if two of the property managers say that yes, there is some social housing there, stay away from that street. Don't buy that property, even if it's really cheap, because the capital growth will be impacted. And another important thing, you will struggle to rent that property out, because the tenants just don't want to rent over there because it's a rough street, right? So that is what you have to avoid. Another thing is gentrification. Now let's going back. Now, what does gentrification really mean? So in this case, we have to make sure that the people or the population who's living in that target suburb where we want to buy, there should be different kinds of population living in there. And that is where a lot of people have this myth that buying in a regional town or in a regional area away from a capital city essentially means that we are buying in a bad area or in a mining town. Now, the problem with mining towns is, and I've told this before as well, we discussed that a couple of weeks ago, mining towns have probably 60, 70, 80% of population in a suburb who are all miners or who are all related to mining industry. If the mining industry goes up, there are a lot of jobs, they are working. If the mining industry goes down, let's say the overseas contracts for mining are finished, suddenly the workers have no work, and suddenly they lose jobs, and suddenly the properties are no more rentable over there. You can't find tenants because people just don't want to live over there. And that is where the problem happens. So stay away from mining towns, guys. I can't overemphasize on this. And how do you make sure that you stay away from them? You actually find areas where the population living in there belongs to different categories. Like there should be IT people who live in those suburbs, people who are doing professional jobs, people who are in healthcare industry, people who are in education industry, people who are in hospitality staff, people who work for government services, people who work in administration kind of jobs. And all this data is available on ABS as well. Plus, you have to validate that data with the local property managers when you're actually talking to them on phone. That yes, ABS shows me that there are multiple kinds of people who work in different professions over here. Is that really true for this particular street or these two streets as well? Because I'm looking to buy in these areas, and the property manager will give you that information. Now, these are some of the data points we have talked, guys. I just want to give a disclaimer. We have not discussed all the data points. We have only discussed a subset of data points. Typically when we are doing the search, we will go through more data points. But if you're looking at these factors, you will be able to nail down a handful list of suburbs where you can really expect some good capital growth over the next 24 months, even in the first 12 months as well. And this will give a good short list of suburbs. Now, how do you find all this information and where do you find it? These are some of the data sources. Feel free to take a snip of it. With these data sources, they all come with different subscriptions. Some of them are free of cost. Some of them are paid data sources, like DSR data is like 300 a month kind of thing. Archistar, which tells about zoning and other stuff about the property and how about the other properties around the land and how the lot is and what zoning it belongs to. That is around $1,700 a month. It's a very expensive subscription. RP data, CoreLogic, and Price Finder is around $200 to $300 a month. For each one of them, profile.id is free of cost. SQM Research. It has a free and a paid version, and so does Microburbs. So Microburbs also has a paid version as well as a free version, and of course, a lot of information is not available in the free version, but even the free version is good enough. You can still use that one. CanStar and Hotspotting are based on the reports that you buy from them. So for every report that we are buying, we are pretty much paying them between 200 to 400 bucks. But it depends what kind of report you are getting off them. Then hashtag is like five 600 a month kind of subscription. Suburbs Finder is another like 1200 for 6 months roughly, or 900 for 6 months. That is a subscription cost for Suburbs Finder, and there are different layers within that. ABS website, most of the information is free on ABS website. And then we have real estate and domain. And the two most important things which I did not talk about, the right at the top of this table, the local council professionals that you talk to, because they are the ones who tell you what is, once you get information, let's say about future approvals, right, for a council, you go and call the local council and you validate that data. And I can see that only 200 new bills have been approved in the last 2 years. And the suburb size, or the suburb of dwelling, the total quantity of dwellings in that suburb is 5,000. So 200 is much less than that threshold that we want to work with. But you still want to call to the council and check them that these 200 new approvals, are they for commercial, are they for residential? Because if they are for commercial, even better. Because commercial activity is increasing, which means jobs are increasing in that area. So make sure you call the local council. You also need to call the local council for some other stuff which we haven't discussed today, but I've covered that in the next slide. And of course, local real estate agent relationships, because you can have all the data sources in the world, which I've mentioned over here. But the problem is, if you don't have relationship with the local agents, you will struggle to source the property. So you have to build that relationship. You have to call them every week. You have to speak to them, call them at the right time, make sure you're asking the right questions, and you consistently keep calling them and keep having a chat with them. Usually the best time to call a real estate agent is on a Monday or a Tuesday morning, because that is when you are more likely to get hold of them. Otherwise, they're very, very busy people, right? Now, what we have not discussed today and what should be your next course of action is, once you have identified those growth suburbs, if you can, I know it's not always possible, but that's what we do for our clients. Once we have found any high growth areas, we travel there personally. We travel interstate and we view and we look at those suburbs and we try to get the feel of those areas, because we want to make sure that whatever the data has told us through all these tools are the reality, are the ground realities also stacking up to it, right? So we make sure we go there, we check everything. Yes, it's livable. Yes, it is attractive. Yes, it will attract the right kind of tenants. Yes, it is a calm and quiet area. Yes, it will attract young families. Validate that. That is when we can give it a thumbs up, and that's what you can do. If you can't travel on your own, then that is where you can go and have one of your friends actually visit them. If your friends live in those areas, then that can help as well. Once, if you can make over there, please go and meet local real estate agents, because it, again, as I said, finding the area is only like 30% of the job. Then the remaining 70% is actually finding the right property, because the stock levels are so low right now. You will struggle to find the right property if you have not got relationship with the agents, and the prices are moving fast. Some of these areas where you can buy something for 600 700k, the prices are going up by 50 grand, 100 grand, 150 grand in 12 to 18 months. So if you don't act fast enough, if you take 6 months to buy something, the prices have already gone up potentially by 50 grand, 70 grand in 6 months, right? And I will share an example with you as to how it will help you if you buy at the right time and you can enjoy that growth. Vice versa, if you keep missing out, if you don't have relationship with the agents, if you are late in making offers, if you're not doing your due diligence timely, you will just buy the same thing much more expensive 6 months or 12 months later. That's what you have to avoid. So what we have not talked about is, after you have found the right suburb, make sure you are buying properties which are away from social housing, which are away from busy roads, which are not backing on the highway. That's very important, because that's where the noise comes from. Properties away from T intersections, because T intersections are very busy, and you may struggle to rent those properties out because they are not quiet corners. People want quiet places to live in. Your property has to be away from flooding. Again, we haven't spent time doing it today. We can do another session on that. Your property should be not having excessive slopes, so the slope should not be too much. There should not be any immediate maintenance requirement, like not any immediate renovation of 20-30 grand, because that will hit your pocket straight away. The location should be quiet. And again, the lot size should be regular shaped. And a lot of these things can be confirmed by the local property manager. And some of the data sources which you can use are Arkistar, which can help you confirm some of this information, and the council websites. The local council website provides you the key information. And once you get that information from the local council and Arkistar, you call the local property manager to validate all that information. So this way you are actually validating everything you are getting from the council website, from someone who's physically on ground, who's managing properties, who know about the area in and out. So it's very, very important that you call local property manager and verify, is it really a flood zone? Because the council says it's not. Can you please confirm that for me? Simple questions like these. Okay, so this is what we did, and these are the suburbs. This is a bit of a gift for you guys. So when I ran that search, which we discussed in the beginning, that our budget would be less than 900K for today's discussion, rental yield of 4.5% or more, and we will be targeting well-connected suburbs with the criteria we shared earlier in the table. You can go back and view that criteria. We found 57 suburbs in total, anywhere from the 450K to 900K price point. And as a gift, these are the 5 suburbs that I'm more than happy to share with you. A couple of them are in Perth, and the other 3 are in Queensland, in Cairns and Mackay region. So take those suburbs. If you want to investigate them further, feel free to do so. But I've shared those 5 with you purely as a gift. But there are 57 in total that we found and where we are currently buying for our clients. Right now, deal of the week is just to share what we have been finding and what we have been buying. So this is a property we bought recently in Avely, in one of those 57 suburbs, and we bought this property. It's a 4-bed, 2-bath, beautiful double garage house. It's only 9 years old. So it was built in 2015 in fact, right? We bought it for $738,000. It's a really premium location, and 20-25 minutes drive from the CBD. Avely itself is a very premium suburb. The property is renting for 700 per week. You can see some of the photos. It looks beautiful, right? And the income of this area is increasing very well. As when we compare the census data, people are making much, much more income who live in this area, because it's really premium and they can afford the higher prices. And in the 2 months since we bought this property, because it meets all our key criteria of growth, this property is already touching $780,000 in value in terms of its valuation. So what that really means is that just buying in the right area, something for 738 grand, in 2 months time, the valuation as per the bank is coming back at 780 grand. So the client has pretty much made $42,000 of wealth or equity in a safe way, whatever you want to call it, wealth or equity. And what that means is that if they wait for another 6 months or 12 months, this will potentially rise by another 50 to 100 grand, which means they can go to their bank after 1 year or even after 6 months. Like when I talked to them over the weekend, they were like even thinking to have a chat with their bank in 3 months' time, just after Christmas, and ask them if the value has risen enough, can they refinance, pull some money out as a cash, and use that money as a deposit to buy another investment property. Because that is how you build property portfolios. That is how you grow your wealth safely. This is renting from day one. We haven't had issues to rent it out, and this is in a premium location. So there are no headaches with this property, no challenges, no maintenance, calm and quiet location, and it's just ticking over on its own. Like Avely pretty much has been growing at 15 grand to 20 grand per month. That's the average price growth for Avely for the last 6 to 12 months, right? And this is continuing to grow, so it will not stop for the next 12 months easily, because there's enough room in the price movement to happen based on all the data that I've discussed with you today. So guys, this is just one example for deal of the week. And if you have to discuss your personal situation, more than happy to have a chat. You can book in a QR code. I know sometimes it's difficult to ask questions online. Sorry for the longer session today. I was expecting it to go long, but book in a call if you want to have a chat about your personal situation. If you want to discuss something privately, more than happy to have a chat. But please go out, do your research, try and find these locations, try and build relationship with the agents, and try finding these properties while the stock levels are still low, while it's still difficult to build new properties. while the migration levels are so high, there's more and more population coming in, which is just buying anything and everything at this point of time. So make sure that you buy strategically, you buy in the right spots, and you enjoy wealth creation for you and for your family. Until next week, take care. I'll see you next week around. And if you're watching the recording, please post your questions. I'll answer them in the next week's session. Until then, take care.